The credit figures were the first of the host of data releases this week. They show lending to companies grew strongly, while household credit growth decelerated further in February. Analysts say it's not surprising that households are cutting back on credit as they face slow growth in disposable incomes due to rising inflation and higher interest rates. Strong corporate credit growth, on the other hand, could mean that companies are looking to invest in the economy.
We also saw in the Reserve Bank's recent quarterly bulletin that private sector investment had ticked up to some degree. So maybe this is the result that we see now. It's starting to take effect on the credit side. However, I don't think we should become too excited because confidence is still fairly weak if you look at confidence surveys. Clearly there are lots of issues, both domestic and international, which companies have to get their heads around before they put a lot more in the way of additional capacity.
Also out today is data on the country's trade balance for February. It shows that South Africa recorded a trade surplus of 1.7 billion rand after a deficit of 17.1 billion rand in January. That's on the back of a strong surge in exports, particularly vehicles and equipment, while imports fell sharply.
Another factor of the trade balance, of course, is the strikes, and that will cause the figures to jump around from month to month. But I think one's got to look at the overall longer-term trend, and that's relatively encouraging.
Tomorrow sees the release of the Purchasing Managers Index, which is expected to point to ongoing recovery in the manufacturing sector. Other data out this week includes consumer and business confidence as well as vehicle sales. Economists say on balance, the data will likely show an economy that remains weak, weighed down by negative sentiment arising from a weaker rand and rising interest rates. SABC News, Johannesburg.